Good morning. It's Tuesday, the 29th of October, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming usually from Mumbai, India's financial capital, but in transit right now. A heads up, we will be on a short Diwali news break from tomorrow, though we will have a special discussion on values-based leadership with R. Gopalakrishnan and Harish, Bhat, both former Tata Group honchos and authors. And the Core Reports Weekend Edition will, of course, be back on Saturday, and it will host an insightful conversation with Saugata Gupta, CEO of consumer goods major Marico. And now on to the news. The markets recover on Monday, pushback against the bears. How long will that last? Oil jumps as some calm returns to the Middle East. India's states are on an unprecedented spree of freebies, even as their revenue slows down. The Tata Group expands aircraft manufacturing capacity to Airbus light military aircraft. And uncertainty in Japan as a snap election has mixed results.
This is the Core Report with Govindraj Ethiraj.
The Bulls win the battle on Monday. On Monday's battle between the Bears and Bulls, the Bulls finally won, but not before the Bears had claimed their share of spoils. The indices jumped over 1% during trade on Monday, with the Sensex shooting over 1,000 points at one time before sliding back. The good news, at least for those in the markets, was that the week began well. The question, of course, is will this hold? And let's spend some time on that. Before that, the market is still weak and the bounce backs are driven by sheer domestic supply of funds rather than anything else. For example, corporate earnings are definitely down as we've been reporting, and there is a lot of foreign institutional investors selling, and a lot of the $10 billion that has been sold this month by them has been in consumer-facing industries and stocks, reflecting their outlook too. A report from Nomura Securities dated Monday says Indian urban demand is likely to stay soft. The report flags fading pent-up demand, high interest rates and tight credit, but also highlights lower salary increases. And it also points to a slump in passenger car sales, moderation in airline traffic growth, and weak demand for FMCG company products. The core report has been highlighting, among other things, falling car sales for several months now, including the fact that inventories at dealerships have been rising steadily to record levels of over 80 days right now, or stock of vehicles worth close to 80,000 crore rupees. Back in the market, it's a liquidity-driven one, which also means, like I said, that bounce backs can be faster than normal. Using the Hindu calendar, roughly from Diwali last year to later this week, local investors have invested something like 460,000 crore rupees in equities during Samvat 2080, that being the calendar. And this is the highest amount ever invested by them in any Samvat, according to data reported by Business Standard. And not surprisingly, this was in stark contrast to investments by foreign portfolio investors who invested about 90,000 crores in Indian equities during the same period. The liquidity surge has led to the Nifty and Sensex returning about 24.5% and about 22% respectively in 2080. That's Samvat 2080. Now this, by the way, is despite that recent 8% correction from the top that we've been seeing in the last couple of weeks. The best performance for the markets was in Samvat 2077, which was post-COVID, when the Nifty and Sensex went up about 40% and 37%. The Nifty Mid-Cap 100 and the Nifty Small-Cap 100, of course, have done better, surging about 35% on an average in the same Samvat. And now to markets on Monday, the BSE Sensex finally closed up about 602 points to settle at 80,005. The NSE Nifty was higher by about 158 points to close at 24,380. Small cap stocks outperformed broader markets, and the Nifty Small Cap and the Nifty Mid Cap were high, or rather much higher. All sectoral indices ended in the green. Banking stocks were actually leading the charge on Monday. Oil prices fall as calm returns for now. Oil prices expectedly fell more than 6% on Monday after it emerged that Israeli strikes against targets in Iran avoided its oil, civilian or nuclear facilities, raising once again the hopes for peace in the Middle East. Brent fell below $72 a barrel and West Texas Intermediate was near $68, Bloomberg reported, adding that there were signs of the market's political risk premium fading across the board. Citigroup has cut its Brent price forecasts, citing lower risks from the conflict in the Middle East. Iran's missile attack on October 1st had earlier slapped a war premium to oil that at times pushed the global Brent benchmark above $80 a barrel, says Bloomberg, but pointing out that prices are still $20 lower than the first session after the October 7th attack that started off this conflict last year. So the reason for this, which is the low prices, is of course weak demand, as we've been pointing out here too, particularly thanks to China, the world's largest crude importer, facing a weak economy. And then there's the other part about an oversupply of crude. The Organization of Petroleum Exporting Countries says that it will, or rather has been saying, that it will start gradually reviving oil production in December, and the market is watching for any change in that timeline. Bloomberg also said, adding that while the planned output increase in the near term is small, it will add supplies to a market that the International Energy Agency forecasts will not be in need of them. Uncertainty in Japan. There's more geopolitical news and uncertainty, but this time from the east. The Japanese yen dropped to a 3-month low after a snap election resulted in no party with a clear mandate to lead the country, which is also the fourth largest economy. Analysts prepared for days, possibly weeks of political wrangling to form a government and potentially a change of leader, and comes at a time when Japan faces economic headwinds, tense security situations fueled by China and North Korea, and a week before US voters head to polls, according to Bloomberg. The direct tax sweepstakes. Karnataka and Tamil Nadu are amongst the top 5 states in India that account for 70% of India's total direct tax collections in the country. There are 28 states and 8 union territories in India. The western state of Maharashtra, from where the core reports comes to you faithfully and daily, leads with a roughly 39% share of all direct taxes paid in India. Karnataka and Tamil Nadu figure at the second and fourth place in that order, says a report in the Business Standard, which also says that Delhi has taken the third place, followed by Gujarat. Moreover, Maharashtra, Delhi, Karnataka, and Tamil Nadu have per capita contributions exceeding the national average. A dive into state finances. Having spent some time on direct taxes, this sets it up for a larger discussion on states themselves and their finances. Remember, we mostly speak of central government finances and spending and not states, when states together in India spend more than the central government. So India's center and states are now moving in different directions post-COVID. While the central government has outpaced its revenue targets, which in turn has helped it maintain a solid run in capital expenditure or public spending on areas like infrastructure, India's states have been consistently missing revenue targets, forcing them to cut various heads of expenditure, according to a new report by brokerage Emkay Global. All of this obviously comes at a time when states spending in areas like freebies ahead of elections has gone up drastically. The report says of the 10 major states to go to polls in 23 and 24, nearly every state has introduced new freebie schemes regardless of party lines, while MK says, as we know, that this is not a completely new phenomenon. The current cycle is unprecedented and can lead to more fiscal slippages. For example, one area where state largesse continues to rise is power subsidies, and the study says a handful of states, including Uttar Pradesh, Rajasthan, and Bihar, have power subsidy bills that are almost 75% of their entire subsidy bill. Another interesting insight, states with large populations do not generate more indirect taxes despite having a larger consuming base. Perhaps this was somewhat expected, but quite likely there was a narrative developed to the contrary. Anyway, the report says that with the goods and service tax being levied at the final point of consumption, which is what you and I pay when we buy things or consume things, it was felt that large states would be bigger taxpayers. But it turns out that the bigger GST collections are still with the exporting states like Gujarat and Maharashtra, that is exporting to other states. So unless actual incomes go up in these larger states, tax collections would not rise as expected. I reached out to Madhavi, Arora, chief economist at Emkay Global and author of this report, and I began by asking her to walk us through the key findings, and we also dived into some of the other specific points.
So if you look at the post-COVID, fiscal policy of India, it's very important to see center and state combined, because states spend almost 60% of the total expenditure that the federal government overall spends. So just looking at center and not focusing on what states are doing will give you a very half picture of the fiscal policy of India. And in the end, the fiscal multipliers are the one which actually, have a more medium-term impact on either your productivity or your domestic capital in India, and other factors which impact the consumption theme as well. So it's important to see what center and state together are doing rather than just focusing on center, which is where large part of the market focus also generally has been. So if you look at the pre-COVID period, what happened was that, states post 2013-14 were actually asked to take up a large part of their off-borrowing debt, wherein they support the state enterprises. There was a massive power restructuring that was happening, and states were made to actually take that on their books instead of keeping it off balance sheet in a dirty balance sheet way, which made the state's fiscal look very ugly. So there was Saugata, which was following the fiscal consolidation path. They were trying to move to a 3% fiscal deficit target. States were struggling. And states generally cannot go beyond a 3.5% fiscal deficit. I mean, they can go a little higher, but they can't borrow more than 3.5% at this point in time from the market. So very rarely would you see states actually going above 3.5%, 4% on an average, because they need to fund it from some sources. Market sources being the cheapest one. They generally stay around 3.5% or below on a consolidated level. But still, they were, relatively more expansionary than center. Post-COVID, both center and state, because their balance sheet had expanded a lot during COVID due to the spending that they had to do and the debt that India was building up on the public sector, they started consolidating. So both center states started consolidating post-COVID. Center had gone as high as 9.2%. States were also running much ahead of 3.5%. Then they started bringing it down towards their normalized level. That means that both of them were contracting their balance sheets. So that is why when you talk about, market players saying that the government hasn't done much in terms of consumption, the reason being the balance sheet of center and states were actually contracting. It was more focused towards capital expenditure over revenue expenditure. And on net, the fiscal deficit was coming down for the country as a whole, which also means that incrementally, the spending was going lesser than lesser compared to what it was on the period of COVID, which obviously is understandable also because the economy had improved as well. Now, the difference in the way center and state were consolidating is very stark. What center was doing, that center was able to get a very high income. The tax revenue growth was much better than what they expected. We are seeing a massive improvement in personal income tax where, owing to policymakers, ability to sort of track the PIT, that there's been a massive growth in that front. So they were able to get a good income. Thus, the income profile was good. They were able to spend in line with what they were planning to. States, on the other hand, have been struggling on the revenue side, which is where we are trying to focus on as well. That, some part of the state's money comes from the devolution, that whatever center earns in the taxes front, a part of it goes to states according to their share, and rest would be their own tax revenue stream. And that is where they have been struggling. A lot of states are not able to raise enough tax revenues. And thus, what they were doing was that they were also consolidating, but they were not able to get the same kind of revenues. They were cutting their spending. So both in the capital expenditure and on the revenue expenditure, states were actually cutting their spending and thus were able to, generally print in a much lower fiscal deficit than they initially budgeted beginning of the year. And that has been the way both consolidations of center and states have gone, but in a very different manner. Come FY25, there's been a massive change in the political capital in India. We saw the national results also showing the sort of a less strong mandate for the Modi government and also a little different positioning of states with regard to their, political capital as well. And of course, the election cycles around states is also something which is happening. And that has basically led to states becoming much more.
So you've called it unprecedented freebies.
Yeah. So the freebies, and they're also keeping a very high capital expenditure because they are not trying to match center in terms of capex. So they have actually built in a 2.5% capex to GDP ratio, which is one of the highest in a decade or so for the states. But they're also building in a very high revenue expenditure. Almost 7 states have come out with modified budget post February, March, of which Maharashtra is a case an example. Some of these states have expanded their fiscal deficits, some have kept all. But overall, the FD to GDP ratio for states pre these modified budget was close to around 3%. Now it is a tad higher than 3%, but nothing too dramatic. Now, what states have done is that they've also sort of tried to be very smart in terms of how they are positioning their fiscal books. They've kept their revenue estimates or assumptions extremely high. For example, looking at SGST growing at 18-20% on an aggregate basis, while centers' own CGST is looking to grow at 10-11%. And both of them are coming from the same revenue stream. So they've kept a very unrealistic estimates for their income side, which is where they're able to then show that, we will be able to fund our excess spending. A large part of it is going on non-merit subsidies, and then we will be able to still match 3% fiscal deficit. That is where the struggle is. And states are not only going to be facing this problem of income side this year, but even in the longer run, if they don't find avenues to improve their revenue side of their balance sheet, they will have problem in terms of raising resources, and they have to be more innovative. A part of it could be done by, improving the GST slab, the states benefit, but a lot of states have to work on their own tax revenue stream, wherein, they will have to ensure that they at least grow 1.2, 1.3x of the nominal GDP to be able to have a much higher tax buoyancy if they intend to really service the kind of revenue expenditure expansion that they are doing in this year, election year. And half of it would be basically a permanent damage on their balance sheet.
Right. So one of the things you've pointed out, if I got that right, was that 75% of total subsidies at states is for power, discounted power or free power. Is that correct?
Yes. So a lot of states like Punjab, Haryana, almost 90% of the subsidies are only powers. And they've also tried to expand that bit further around the election period.
Right. Okay. So the other point is that if you were to look at GST collections, goods and service tax, and you referred to it already, you've also pointed out that, if you're a large state, one thought would consume more and therefore contribute more goods and service tax as opposed to small state who may not. But that's not really happening. What is that telling us?
So basically, that sort of tells us that, the way states have sort of positioned themselves in terms of much higher assumption of a, consumption state getting more collection of GST, or rather a state which has a higher population is able to make more money out of GST collection, that has not played out. So it's a very, basically shows that the perception people had that just because you have higher GST collection for a state which has a much larger population, ideally you should get higher tax collection owing to their consumption pattern, but that has not really played out. So you've seen that 5 of the most populous states of the 6 that we sort of covered, which is UP, Bihar, West Bengal, and Rajasthan, actually there's 5-year CAGR growth of GST is much lower than states like Tamil Nadu, Gujarat, Maharashtra. In fact, even lower than the all-time average of all India average of around 11.7%, which is the growth all India countries. In fact, smaller states like Orissa, Kerala actually have a higher GST collection than the national average as well. Basically, the myth that just because you have a higher population or larger population, you would probably have a higher GST collection, that theoretically looks to be logical, but has not really played out for these states. In fact, even the producer and consumer state thesis is also not necessarily played out the way it was assumed earlier.
So as you look ahead now, I mean, this is not about which are the best states to invest in or go and stay in, but that could also be one, let's say, angle. You've pointed out that a lot of the capex is really happening on the eastern side, as eastern part of India as compared to the western part of India. And that seems like a good thing. Even if western India or southern India is slowing down, it's because they're already higher in terms of on-ground capital investment. But if you were to look at now the consolidated picture, how are things looking to you? I mean, what are you seeing, let's say, a few years down the line?
With regard to the public policy on capital expenditure, until a decade ago, states used to be actually a much higher portion of the capital GDP ratio, capital GDP ratio compared to the center. They used to generally, do capex of close to around 2.2, 2.3% of GDP or even more in certain years, while center used to be generally around, 1.5% of GDP. Last 5 years specifically, if I say so, there's been a switch in the way center states' behavior have been. States have actually been, the capex GDP ratio have been a tad lower than 2 most of the time. In fact, somewhere hugging 1.4, 1.6% of GDP. While center, on the other hand, has been actually increasing its capital expenditure ratio to the highs of close to around 3% plus. And in fact, this year they're planning to do a capex GDP ratio of around 3.5%. And this year, as I said, states are also trying to increase their spending on capital expenditure. So that's one hope. But, if I look at the last 5-7 years, the center and states combined capex GDP ratio had not increased as much as one would think so, because states were actually cutting their capex while center was increasing its capex. So the combined public sector, capex GDP ratio was actually not as high. It was still close to 6.5% or something. They didn't really change just because center took large part of the backing from the states, and states were more busy, cleaning their books, especially with regard to the power sector reform, which had led them to take those debt on their books. So there was a difference in the way center state spending has been happening. And now I think last year was the first year when you saw states also trying to sort of catch up with center. Most of the times for states, capital expenditure is a residual item. They generally do it in the fourth quarter of the year, in fact, in the month of March itself, around 20% of the overall capex of states generally used to happen. And states tend to generally undershoot their initial budget by around 20-25% on an average. So last year was an anomaly year wherein states had actually front-loaded their capex in line with center. They were pushed to front-load their capex in the first half of the year, and they were also led by BJP-led states. States were almost able to achieve 90% of the budgeted target, which I think this year is going to be a difficult task, because insofar states are actually lagging. The capital growth has been negative in the first 5 months of the year. For center also, it has been negative partly, or has been much lower, partly on account of the fact that they couldn't spend an early part of the fiscal year or into elections. The second half of the year, if states actually intend to really catch up on their budgeted capex, they'll probably have to go 40% capex on a Y&Y basis for the rest of the year. Same with the case with center. around 30% plus. The center may be able to still achieve that. So I think second half of the year, you will see some capex projects, being in noise, but I think states will have a difficult time catching up on their budgeted capital expenditure, especially because they are struggling with the revenue side. So whatever revenue they're getting from the center or from their own tax revenue, they might be focusing more on, doing freebies and subsidies and actually expanding the capital bit. So I think overall, center cum state combined, capacity ratio is budgeted to go higher this year. But we'll see how it plans out, because if there is going to be strain on state's budget because of revenue side or because of higher expenditure on subsidies, capital expenditure will be a residual item.
Right, Madhavi, thank you so much for joining me.
Sure. Thank you.
More aircraft manufacturing in India. Some manufacturing news now. The Prime Minister Narendra Modi and Spanish Prime Minister Pedro Sanchez inaugurated the Tata Advanced System or TASL Airbus facility to make C-295 military aircraft in India. The TASL Airbus facility is the first such private sector final assembly line for military aircraft in India, according to reports. A total of 56 aircraft were to be delivered, of which 16 are being delivered directly by Airbus from Spain, and the remaining 40 will come from this facility in India. The C-295 aircraft was initially manufactured by Spanish aerospace company CASA. It's now part of the European multinational Airbus Defence and Space Division. The C-95 is essentially a transport aircraft which has the capacity to carry up to 71 troops or 50 paratroopers. It can also be used for logistic operations to locations that are not accessible to current heavier aircraft, and it will replace the Indian Air Force's Avro 748 planes, according to reports. This aircraft can also airdrop paratroops and loads and also be used for casualty and medical evacuation. The Defense Ministry in September 21 had signed a roughly 22,000 crore contract with Airbus Defence and Space SA Spain for supplying 56 aircraft. The first C-295 medium tactical transport aircraft were delivered to India in September 23. And before we go, here's some feedback. And once again, before I start, thank you very much for taking the time off to write these excellent points down, which I can assure you is going into our programming mix. So Jay Bande, B-A-N-D-E, says, the core report is an excellent podcast and would like us to cover the ONDC weekly and also the National Digital Health Mission's progress. The ONDC is the Open Network for Digital Commerce, and it's a government-led initiative that aims to promote open networks for digital commerce in India. T. Koshi, the CEO of ONDC, was on the core report a few months ago, but we will definitely bring them back. Nalini Chandrasekhar says, superb reporting, and advises us to maybe put data on the screen when you are making database reporting. We'll be able to absorb the numbers better. So we try and do that with the take, which is the editorial that comes in the beginning, and there's a separate video version of that on YouTube. We've got a few episodes per week already going. We're trying to ramp it up, but thank you very much, Nalini, for your feedback on that one. Ranjit says that he believes several recent government actions have contributed to the FII sell-off. He says that higher taxes, increased expenses and fees. Also, he is confident in general that the market will recover as India has a history of resilience, and hopefully the authorities will make decisions quickly and won't delay. And that's because the government in India has always shown its commitment to supporting the people. Thank you very much once again for all your feedback. We will be now heading for a short break from news podcasts, but we will be continuing with our feature ones, including a discussion on values-based leadership tomorrow and our core report weekend edition with the CEO of Marico, Saugata Gupta, on Saturday. So stay with us for all of that. Thank you very much and have a great Diwali ahead. That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.